Every time the stock market takes a dive, headlines scream about trillions of dollars being wiped out overnight. And most people hear that and immediately panic, assuming their financial future just got torched. But here is the thing that almost nobody explains properly: that money was never really there to begin with. Stick with me, because what I am about to show you will completely change how you think about market crashes forever. Let me paint you a picture. Walk into any grocery store and imagine every single shelf is stacked with jars of pasta sauce, each one priced at $2. Now, suppose there are 5 million jars across the entire country. Simple math tells you the total pasta sauce market is worth $10 million. That is the market value. Everyone agrees on it. Life is good. Now, imagine one major retailer slashes their price to $1.50. Every competitor follows suit within hours, because that is just how retail pricing works. Suddenly, the total market value drops to $7.5 million. $2.5 million just vanished from existence, right? Wrong. That $2.5 million never actually existed as real cash. It was a price tag sitting on a shelf. It was a number representing what sellers hoped buyers would eventually pay. Nobody deposited that 2.5 million into any bank account. Nobody transferred it anywhere. It simply reflected an expectation, and that expectation changed. The jars of pasta sauce are still sitting on those shelves completely intact. This is exactly what happens when stock markets crash. When you hear that a market dropped and $2 trillion got wiped out, what actually happened is that the price tags on millions of shares got revised downward. The shares themselves still exist. The companies behind them still have employees, buildings, products, and customers. What changed is what people are currently willing to pay for ownership stakes in those companies. Think about what a share price actually represents. It is not a receipt confirming that cash was exchanged. It is a collective estimate of what the market believes a piece of that company is worth at this particular moment. That estimate shifts constantly based on sentiment, fear, news cycles, geopolitical tension, and pure human psychology. When optimism runs high, prices climb. When fear takes over, prices fall. But confidence moving up or down is not the same as dollars physically moving anywhere. Now, here is where it gets really important for you personally. If you own shares and the market drops significantly, have you actually lost money? The answer depends entirely on one thing: whether you sell. If you hold shares that drop in price but you do not sell them, you have experienced what is called an unrealized loss. It exists on paper. It exists as a revised estimate. But the moment the market recovers, and historically markets do recover, that loss disappears just as quietly as it arrived. The people who truly lose real money during crashes are those who panic and sell at the bottom. The moment you convert that paper loss into an actual sale, you have locked it in. You have taken what was just a fluctuating price tag and turned it into a definitive transaction. That is when the loss becomes real cash leaving your hands. History backs this up painfully clearly. The crashes of 1929, 1987, and 2008 all destroyed enormous amounts of real wealth, but primarily because panic selling became widespread. People forced shares into a market already collapsing under fear, and the chain reaction of selling at ever lower prices created genuine financial devastation. It was not the repricing itself that caused the destruction. It was the mass stampede for the exit. So, what should you actually take away from all of this? Stock market values are fundamentally built on confidence, not certainty. They are sophisticated collective guesses about future worth. When those guesses get revised downward, we call it a crash. When they get revised upward, we call it a bull market. But in both cases, what is really shifting is human expectation, not physical money teleporting from one location to another. A crash is essentially an emotional event dressed up in financial language. It reflects collective fear, overriding collective optimism. And critically, a stock market crash does not automatically equal an economic catastrophe. Those are two different things. Markets can recover sharply while the economy remains challenging, and vice versa. The smartest financial minds in history have consistently said the same thing. Time in the market beats timing the market. Understanding that paper losses are just revised expectations rather than actual cash destruction is what separates investors who build long-term wealth from those who panic and lock in permanent losses at the worst possible moment. So next time a headline screams about billions being wiped from markets overnight, take a breath. Ask yourself whether any real cash actually changed hands across the entire market. The answer will almost always be no. It is just the world updating its price tags. And price tags can always change again tomorrow.